Oh my god, Intel! Oh, it's up 5.5% on amazing earnings, right? Psych! Welcome back to Strongman Personal Finance. We got to go over Intel's earnings that just dropped, because apparently they're so amazing that the stock is up 5.63%. Oh, 5.75% after hours. What's going on with Intel? Are they profitable now? Well, according to their earnings report, they posted positive earnings per share. Interesting. Let's look into that a little bit more. So here's some of the Q3 revenue. So, they have a couple different segments. They have client computing. Their revenue's down 3% year over year. That's their largest source of revenue. Data center and AI, my hot guy, is down 10% year over year. Network and edge is down 32%. And the only two segments that grew were Mobileye and Intel Foundry. And oh, by the way, those are by far the smallest segments. So their largest sources of revenue have all dropped year over year. Wow, that's amazing. And then you go down and you see this very interesting thing right here. This Q3 2023 non-GAAP earnings per share. So according to Intel, they got 41 cents of earnings per share, which is an increase of 11% year over year. Oh, they beat it so good. Wow, they beat me so hard, Daddy. What is non-GAAP EPS? Well, non-GAAP is not following the rules of accounting. Non-GAAP is used by clown companies. Non-GAAP is used to basically make your earnings look better than they are because, I had all these expenses, but I'm just not going to include them, and it's going to be non-GAAP, bro. I mean, basically, I add back all my operating expenses, I add back my cost of goods sold, and my earnings is just my revenue, bro. So let's go look at their actual profit, because they didn't get 41 cents per share. No, they didn't, okay? When you see non-GAAP, as Charlie Munger said, I think about something else, EBITDA, it's BS earnings. This is garbage. This is trash. You have to understand what you're actually looking at. Let's pull up the actual income statement. This is based on the rules of accounting. Let's go line by line. Net revenue from October 1st, 2022 to September 30th, 2023, so a full year, is down. So their revenue is down. Their cost of sales also dropped proportionally. And their gross margin is, let's see what their actual gross margin is. This is their profit from just the items that they sell without factoring in operating expenses. So their gross margin is 42.5%, which is a huge drop from where they were before. I believe their operating margin or their gross margins used to be much higher. Yeah, I mean, it's better than last quarter, but their gross margins have been steadily whittled away over time. And they are not even close to being back to where they were before, okay? Before, they were in the 60s. Now it's 42.5. Wow, Intel, good job there. R&D spending is down, marketing, general administrative is down, and restructuring charges is up. Now, here's the funny thing. They have operating income or loss. They have an operating loss of $8 million. This is before interest and taxes, okay? From the core business, they are still unprofitable. Oh, but earnings per share, they're still unprofitable from the core business. Well, how are they profitable? Let's look. So from operating income, which is before interest and taxes, one-time, one-off things, they had gains or losses on equity investments. So when a public company or when a company invests in another company, but they don't control it, but they have significant influence, they record what's called gains or losses on equity investments on their profit and loss statement. That means Intel has companies they're invested in that have recorded losses, and those losses flow through to Intel's income statement. So you're seeing some of their investments which have also lost money, okay? So they had some gains and losses, but they offset it by interest. Their income and loss before taxes was negative 52 million, even worse. The only reason they're profitable is because of a tax benefit. Oh, wow. Good job, Intel. You are profitable because of taxes. That's a core business function right there, your taxes. Oh, and if we look down here, earnings per share attributable to Intel, 7 cents. But I thought it was 41 cents. Yeah, they've only multiplied it by 6 or something. What a joke. And now their common stock, so they've issued shares. How much have they diluted? Let's see. They went from this dividend, great gross margin, and now they're diluted. I mean, it's not a crazy dilution, but still 2%, okay? So their earnings per share were not 41. They're only profitable because of a tax benefit. That's it. They're so profitable now. No, they're not, okay? Let's look at their balance sheet. So cash has gone down. Short-term investments has stayed the same. Accounts receivable has gone down pretty significantly. Either that's a warning that sales aren't going up, or it just could be a timing issue. Inventories. So we have inventories. This is stuff they make and then they sell. So they have raw materials, work in process. This is stuff they're building, but they're not done yet. And then stuff that they have completed building but aren't sold. Inventories are down. Other current assets down a little bit. That could be their investments. Oh, no, it's down here. So they have property, plant. So they've been investing in property, plant, equipment. Look at that. They spent $13 billion year over year investing in property, plant, equipment. They're shoveling money into investments. Equity investments have gone down. So they recorded a loss on those investments. That loss hit the income statement, and they wrote down their other investments, their equity investments. Goodwill is the same. Intangible assets down, probably due to amortization and other long-term assets. So overall, they had a slight increase in long-term assets. Okay. Short-term debt is down. Accounts payable is down. That's short-term bills. Accrued compensation, that's pay for employees. Income tax is payable. That's tax they have to pay but haven't paid yet in cash. Other liabilities. So other current liabilities are down. Now, if we compare current liabilities to current assets, it doesn't look that bad. Okay, they have plenty of liquid capital to pay their short-term debts. Capital, also known as cash. Debt. Look at this. They've packed on about $9 billion of debt. Good job, Intel. Oh, their assets went up. Man, they're buying all this property, plant, and equipment. Yeah, they're also packing on debt, which comes with interest charges. That's right. It costs money to borrow. Yeah. What kind of market are we in right now? Oh, stockholders' equity. Common stock is up pretty significantly. They're issuing shares, and retained earnings is down. So overall, all you see, it's just BS, okay? Their cash flows from operating activities are actually down year over year. Let's see. Depreciation is down significantly. I wonder if Intel's playing little games here. Look at the change in depreciation. So in the prior year, the same 9 months ended, it was $8.3 billion. Now it's $5.75. I wonder if they're doing the same thing that Google was doing. Oh, well, instead of depreciating over 10 years, we're going to do it over 50 billion years. What that does is they're changing the useful life of their assets so they can spread out the cost and make themselves look more profitable. That's a big drop in depreciation. Freaking scammers. Okay, let's see. Share-based compensation, basically the same. Okay. Gains and losses on equity investments. Whoa, man, they took some huge losses. Or those were gains, sorry. I was about to say. Let's see. Yeah, I don't see that many changes. I mean, their cash flow from operations is down. That ain't that hot, okay? That ain't that good. Let's see. Investments in property, plant, equipment. Yep, roughly $19 billion. Investments, blah, 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 blah. Let's look at the statement of cash flows financing. So they paid off some commercial paper. Partner contributions. I don't know what that means. I guess it's partner contributions. This is probably some kind of equity investment, it looks like. Proceeds from sale of subsidiary. Okay, so they sold a subsidiary. They issued a ton of long-term debt. Okay, so basically they just packed on a bunch of debt. Net on net, if you net it all out and you subtract out the dividends, they packed on $11 billion of debt roughly. That's a lot of debt, okay? Oh, but they pay dividends, which are down massively, oh, by the way. I don't understand. Look at these drops, man. The desktop client computing is down. The notebook is up a little bit. Okay. I mean, everything seems to be just getting wrecked, except for their very small segments. Intel. So don't believe, when you see these stupid reports, a GAAP, non-GAAP this and non-GAAP that. They're only profitable because of a tax benefit. That's it. This is not impressive. They're not even close to where they were before. This This company's still in trouble. Okay, I'm not saying they can't pull through. They might, but it's not as rosy and amazing as you think. So, oh, the stock went up, bro. I'm such a genius. Still a freaking turd. All right, that's my thought on Intel. Piece of crap. Have a wonderful day. Cheers.